Welcome to this Standard Life Investments Global Emerging Markets debate. Our debates are split into 4 sections, and this one's about the best approaches to investing. So, Alistair, let's start with you. So the big question everybody asks, do you do macro or do you do stock picking? What do you do?
Stock picking is what we do. It's what we're best at. We have a strong investment philosophy across all of Standard Life Investments called Focus on Change, where we look for companies where things are getting better, and these things are getting better aren't discounted by the rest of the market. So as fund managers and analysts, that's where myself and Mark spend most of our time. At the same time, we also are cognizant of macro risks. So when we put portfolios together, we make sure that the risks we're taking are the ones we understand, those that come from the bottom up, and we try to be fairly neutral to all the other things which make emerging markets sometimes rather volatile.
Nathan, how about you? I mean, how do you view that macro versus stock picking?
Yeah, well, I think it's obviously quite important to focus on macro, but not looking at a broad spectrum across the whole sphere. If you think about it, you've got a lot of different countries. So individually, you have to analyse them in depth. As an example, if you were to look at India at the moment, India is performing quite well from a performance standpoint. You've had a new president being elected, and there's a lot of impetus behind that. Whereas if you look at Russia on the other side, they're engaged in battles with Ukraine. And from a macro standpoint, that's not very attractive. So you need to be aware of what's happening at a macro level to guide those investment decisions. And then I think, as Alistair pointed out, looking at specific stocks is extremely important also.
John, just continue that theme of macro just for a bit, if you would. When you look at some of these frontier markets, they tend to be. I mean, let's what should we take? Shall we take Nigeria? 85% of their income comes from oil, and it's a sizable proportion of their GDP as well. The old question, you want diversification, all the rest of it. How do you look at that? How do you look at a country, for example, like Nigeria? If it doesn't have to be Nigeria, it doesn't have to be, but a company that's so dependent on one commodity and needs to diversify and is doing its best. Is that an important criterion for your investment?
It has to certainly educate you the way you think about it. For instance, a sort of more mainstream economy with a very similar issue is Russia. I mean, so much of Russia's global income is from energy resources. So although it's a more developed economy, that has a more evolved economy, it still is very dependent upon those energy exports. So that does make you think of the country in a different light. When you look at a large diversified economy like the US, the macro is much simpler in terms of you look at the inflation rates, you look at interest rates, and you know that within that economy there's going to be lots of opportunities almost in any circumstance. Whereas within Russia, you have 2 influences, one or an emerging market or a frontier market. You have to bear in mind that yes, the major players may be energy dependent, and you have to think about the economy as a whole as energy dependent. But then, with the increase in tracker funds that have been discussed, ETFs, is that if therefore you have people move away from those markets, those economies because of those issues, it's going to affect everything in that market as well. So you have to be cognizant of those larger market influences.
Yeah, there's a question which somebody gave me earlier, and if I could test Andrew with this one: have contagion risks reduced or increased based on the behaviour of various emerging market countries during recent correction periods? Is that an issue which you're still seeing?
I think it is, yes. I mean, I agree with a lot of what the other panellists have said. The statistics tell you that most companies' share price performance in the long term depends on what goes on in that individual company rather than the broader macro environment. But certainly there are specific issues with emerging markets that make Contagion more relevant, and that's principally driven by the fact that a lot of their economies are funded externally from external countries, and therefore they are in particularly dependent on external financing, and that means that they share more characteristics than might be the case in certain other markets. So on the one hand, you've got certain countries which have certain types of characteristics, such as big current account deficits, for example, or weak currencies, which perhaps might suffer more from a contagion effect. You've got other countries which might have, for example, somewhere like China that's got strong reserves, in which case they are probably more immune.
Jeremy, you were about to jump in.
Yeah, I was going to say that I think it's important to take a longer term perspective here. And actually, when you look at emerging markets compared to the 1990s, and I sort of made this point earlier, but on balance, a developing country, it's probably better that they're running a modest current account deficit, because it's not usually optimal for a country to be funding all of its investment internally. So actually the real challenge and the question is, if it is borrowing abroad, is it doing so in a way that's improving the productive potential of the economy, or is that investment being badly allocated? So we've done an exercise recently where we looked at crisis risks in emerging across 23 emerging markets immediately before the Asian crisis and now, and a couple of points stand out. One is systemic risk was much greater in 1996 than it is now. There's far fewer countries with very significant imbalances, and even where those imbalances occur, they tend to be milder than they were, in 1996.
Thank you. Anybody on the floor like to? Yes.
It's Alex Brandreth from Brown Shipley. I was just going to ask the two fund managers here, are there any particular themes that you're finding at the moment for new stocks that have entered any of your portfolios at all?
I'd say there are several. So one really important one is the rise of the internet and e-commerce across emerging markets. It's interesting because it's happening quicker in emerging markets, particularly in China, than anywhere else in the world. So we've seen the Chinese retail landscape completely change in the last few years. So although the overall investment climate in China has been quite troubled, some of the investment opportunities we've seen related to this structural change have given us the potential to make fantastic returns.
So another example would be the SOE reform. We were talking about SOEs earlier on. So a number of changes there, changes to telecom regulation in China, in Korea. And so that would be, those would be themes that impact the entire sector. Then there would be sort of stock-specific examples. Sinopec in China, they have a lot of gas stations. When we go to the gas station in a Western country, you can buy your chocolate and all kinds of other stuff. That's not really the case very much in China. They want to make that change, but they recognise that they don't have the retail expertise to do that. So they're actually invited external investors in to help them make that transition and to therefore make more money for shareholders in the process of doing that.
Gentlemen, thank you very much indeed. We've been discussing the best approaches to investing. Join us next time.